Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
We're kicking off the last month of the year with a couple of top retail stocks for your consideration. Particularly timely as we get into the holiday shopping season with our strategists Nina Mishra here at the desk with me and David Bourne, who's out there in cyberspace joining us via Skype. And Dave, since you are out there, I'm going to start with you. You're looking at Dick's Sporting Goods.
I am. So in this historic economic expansion and 10-year plus bull run in the markets, the strength of the U.S. consumer has been a really important driver of corporate revenues and earnings. And while traditional retail has suffered somewhat in the face of stiff online competition, the best retailers are not only surviving, but really thriving. And Dick's Sporting Goods is definitely among the best in that category. They recently turned in a really nearly perfect quarterly earnings report in which they beat analysts' expectations for revenues and earnings and significantly raised full-year guidance. And it was an especially crucial time for the company to show investors what they were made of. Dick's had taken a fairly aggressive and in some cases somewhat controversial stand on the issue of gun control in the wake of several deadly mass shootings and discontinued the sale of certain kinds of firearms and completely ended the sale of any guns or ammunition to any customers under 21. As a matter of fact, they even physically destroyed about $5 million worth of unsold inventory of military-style rifles because they didn't want them to fall into the wrong hands. Now, they had been one of the country's largest retailers of guns and ammunition, and investors and analysts were rightfully cautious and concerned about the effect that would have on sales at Dick's. But it, fortunately for the company, turned out that those fears were somewhat unwarranted. Dick's sales have been rising significantly, including an unexpected 6% beat in same-store sales in the most recent quarter. It also turns out that the hunting and shooting items that Dick's discontinued selling were among their lowest margin products. So while the decision to limit those sales seems to be appealing to a large class of socially conscious customers, the company's also been proactive in replacing those items that they don't no longer sell, using that available store space for higher margin items that make a lot more money for the company, especially a selection of women's and performance athletic apparel, including some very profitable and high margin in-house brands that sell a lot better at greater sales volume and greater profit. So that recent rise in full year guidance has led to a slew of analyst upward revisions, and that earns Dick's a Zacks rank #1. And on top of that, they also get a score of A in all of our styles for value, growth, and momentum, essentially the Zacks perfect scorecard. Now the shares, they saw a significant rally last week after that great result, but they're actually still very attractively valued. They trade at less than 13 times 12-month forward earnings, which is a lot less than the S&P 500, which is almost 19 times forward 12-month earnings right now. And they pay a reliable and attractive dividend of 2.4%. So when you add in the fact that what's shaping up to be a very successful Black Friday and holiday shopping season isn't even reflected in those results, that's coming next quarter, it's easy to see why Dick's is my top stock pick today.
All right. Does the fact that they're kind of in a specialty niche have any bearing on the fact that they're doing so well? Because typically specialty retailers do pretty well.
Sure, absolutely. I mean, again, the management at Dick's is very, very good at picking a product mix that appeals to clients while also selling things that make them a lot of money. So they're proactive about getting rid of the things that don't work and changing out the space to things that do.
All right, thanks, Dave. You also, Nina, talking about another omni-channel retailer, Target.
Yes. So it seems that holiday shopping season is off to a strong start.
Yes.
And there are clear winners and losers. Retailers like Target, Walmart, Best Buy, and Dick's that are able to offer some value and convenience to customers, they are doing very well. Mm-hmm. And they are able to compete with Amazon and even gain market shares. And Target they were struggling earlier, a few years back, but in 2017 they launched, they implemented a turnaround plan. They remodeled their stores, improved their stores, also launched a small store format, launched many exclusive brands, cut prices, and then introduced store pickup and same day delivery. And those measures, they are bearing fruit now. They had another very strong quarter of sales growth. Results beat both on the top and bottom line, and they also increased their guidance for the year. So if you look at detailed estimates by going to the quote page, you will see that many analysts have increased their estimates for the current and next year after those strong results. And if you go to the price consensus and EPS surprise chart, you will see that they were struggling earlier, but after the success of their turnaround plan, they have been continuously seeing quarter and quarter of strong growth. Now Target has 1,800 stores, so it is very easy for customers to shop online and pick up in stores without paying any shipping fee or without being any membership fee like Prime, Amazon's Prime.
Sure.
And when you go to the store, you generally end up buying something else too,
Sure.
in addition to picking up your online order. And Target has been gaining share in categories like home, apparel, beauty. Those are the things where people like to try on and then buy. So that is why they have been doing very well. And another reason why I like Target is that they have been returning a lot of cash to shareholders in the form of dividends and share buybacks. And in June this year, they had again increased their dividend by more than 3%, and it has a very nice dividend yield of 2.11%, 2.11%. Now, it is a Zacks rank #1 stock. It is almost doubled in this year, so definitely not looking cheap, but given their growth potential, I think they are worth a look. In the industry rank and the sector rank also looks very nice. It's top 10% for industry rank and top 6% for sector rank. Now, some other measures that they have initiated recently, like a partnership with Disney. They are launching 25 Disney store in 25 of Target locations. So all those measures are going to, drive growth going forward too. So I think the stock is definitely worth a look.
Okay, and do you own either of these retail
I do
stocks?
not.
No, neither one.
Neither.
Hey, Dave, how about you?
I don't, Terry, not personally or in any of my Zacks portfolios. Nope.
All right, thanks for that. And don't forget, check out more stock information on our website, Zacks.com. If you haven't already, just get on over there and start scrolling through. And also, if you haven't checked out yet, this offer for a limited time only to let you be able to peruse through Zacks recommendations, insights, buys, sells, and look into some of the Zacks services that are closed typically to outside investors, open only to subscribers. You can do all of that just for the meager fee of $1 and for a limited time only. So get on over to Zacks.com/promo for more details on that. And with Nina and Dave, I'm Terry Ruffalo.